Okay, let's take a look at these buy and sell signals. This is the S&P 500 futures. By using an oscillator below, we can tell if the market is gaining strength or showing weakness. You can see on these two short signals, the market was in a downtrend, but this oscillator, there's a specific set of rules you can use with this oscillator to show that the market was in a weak trend and a weak mode. So at this retracement, the smaller retracement actually formed two dojis at the time, an indecision bar, and then a pull-in bar came right afterwards. You can see the oscillator was really weak. There's two specific lines that I like to use specifically for downtrends and uptrends. This would be my overhead resistance line. As long as my oscillator stays below this level, when you get your pull-in bar, which I specifically go over the exact rules how to do this on any given market. This works on all futures, all stocks, currency, Forex, even crypto markets. So what you're doing is you're taking a blank chart and basically you're looking for momentum in the market. This oscillator, when you put these values on, when the market does start retracing, if this oscillator stays below a certain value, which I'll show you how to do, if it stays below that value, then the market is showing weakness, and then you get a pull-in bar, and that was a short signal to that exact candle. Stop placement would be just above this candle, which I go over exactly how to do that with my parameters. I'll show you exactly how to set up the blank chart on any given market, on any time frame. This works on all time frames. This can be used for stocks or any futures, etc. On daily charts, weekly charts, monthly charts, 5-minute charts, tick charts, volume charts, range charts. It really doesn't matter. Renko charts. This is a Renko chart that I have above right now that you're looking at the S&P 500 futures, but. Then the market proceeds to go down. We moved quite drastically down from that 56 and a quarter level as low as 49. It fell almost 6 S&P points or 24 ticks. And then we got another retracement. We had an up candle. But watch the oscillator. Oscillator still showed weakness. It stayed below my specific value. This is supply. This is what's called a supply line. This is overhead supply in the market. So this supply, as long as that oscillator stays below, we're in a possible vertical push. It stayed below the supply level. Right here, it came up, stayed below. You got your pull-in candle, which I show you how to do that. And then, so the entry according on this Renko bar was 50.49.50. And then the stop to have limit your risk would be above that swing high. So then the market gets strong. We start moving up and the oscillator gets pegged. It gets pegged above. This is one of the requirements that I have. It gets pegged above. The oscillator gets pegged above my 80. Above 80, the market is showing major strength. But then what it has to do is got to stay above my demand line. Now my demand line, according to this oscillator, is at this level down here. So it's very simple to set up on your own charts. It actually works on all time frames, and then pretty much all platforms have this oscillator to put in, and then you can put the supply demand line on also, so you can see it. But you can see that this is one criteria. I go over the exact criteria for you guys, what to look for. The market got strong, gets above 80, and then instead of pulling back all the way back below the oscillator, down to 20. This is where a lot of traders misuse oscillators. They think you want to buy low and sell high, or sell high, buy low. Well, that's actually counter trend trade in the market. Really, what you want to try to do is you want to try to sell low and cover lower, sell low and cover lower, buy high from this low. Instead of trying to catch a falling knife here, trying to figure out where the bottom is, let momentum come in, and then take the momentum pullback, which I show you how to do. As long as it stays above this demand line, this oscillator, which it does, it stays above my demand. There's my demand line. Stays above it, very simple. I get a pull-in bar. That's where the green arrow is. And the S&P just really takes off from 50, 50 and a half. The swing is 50, 75. Really moved, really nice hard move to the upside. You can see it got pegged above this 80. This is showing major strength. When you see this happen, this means the market is really trending hard. The market's in a stronger position. And this is where counter-trend traders typically get taken to the woodshed because they are trying to short this hard peg move from 50.52 to 75, when in reality, what the smart money is doing is they're just grabbing liquidity on every pullback and trying to jet that S&P 500 higher. You can see what it tried to do again. We tried to pull back here. You get a little retracement. You had two dojis again, or what a lot of traders call tweezers. Two tweezers came in again. This is just a continuation trade. The oscillator was above my demand line. Needs to stay above my demand here at this level. There is your demand. Stays above it, reverses. There's your pull-in bar. Stop would be right below it. And then the S&P proceeds to move higher from there. The stop below here on these tweezers down here. You had two tweezers right here also. And then the stop started moving. You had a tweezer short, another short here, tweezer long, tweezer long. But you can see that you can use the demand line here, this demand line, as long as this oscillator doesn't pull back below. Now, if this oscillator would pull back, and it pulls back and it breaks this level, my demand line, my demand oscillator right here, that means the market's showing weakness, and then you would not take the pull-in bar coming up. But it did not. It's showing strength, and then it starts to move higher. So that tells you, it shows you, let me put this in green. It's supposed to be green. That shows you two buy signals and two short signals on the S&P using selling weakness, buying strength, where a lot of traders tend to focus on, and where they tend to, when I was a guest speaker in the Las Vegas trade show, there's over 6,000 traders around the world, and typically a lot of traders like to counter-trend trade the markets. Well, this way you're not counter-trend trading, you're actually buying high and selling higher with order flow. And then you're actually shorting low and buying lower. Very counterintuitive what a lot of traders are taught in books and educators. You're selling low and covering lower. So this is totally opposite what everybody's typically taught. They're taught, hey, buy low, sell high. Well, if you buy low, sell high, if you're trying to buy low and trying to catch this falling knife right here, you don't know where the bottom is. You don't know where this bottom is. Or if you're trying to sell this runaway train, you're going to typically get ran over. And that's what feeds order flow. A lot of traders, a lot of these oscillators and free indicators that are out there, and this is a free indicator that's on pretty much every trading platform. Traders just don't apply it correctly. They think, hey, let's just because it's oversold or overbought, just because it's overbought up here and it's above 80, it's overbought. It's got to pull back, and that's that counter-trend trading mindset. And that's something that I try to educate traders not to do. I'm totally opposite. Let's buy this market move when it's moving higher, because what happens is you get these counter-trend traders that come in the market, and what happens? They got to cover their positions. They'll get short because it's overbought. Then they get taken out. Then they'll try to short again. Then they'll get taken out. It's just like this is a self-generating trade because these trades feed off counter-trend traders. So that's a great way to, trade order flow. And we'll do more videos on this. I'll show you a lot of other markets. It works on all markets. This is one of my Renko bars I like to use, but on the S&P. But this works on, like I said, minute charts, share charts, tick charts. Really doesn't matter as long as you're trading the strength of the market. Okay? So I'll be doing another video here not too long from now, and I'll post it on here. But these are the basics of trading just off of a blank chart. Just taking a blank chart, right, and trading order flow. and using an oscillator. Oscillators are second or third tier indicators. If you don't know how to read them, if you typically just want to buy low and sell high, an oscillator is not overbought, oversold. I don't believe in overbought, oversold. I believe in stronger and weaker markets, because once these markets get pegged, they tend to feed on the counter trend traders, and that's the order flow we want to see. All right, so I'll be putting a video in here shortly.